702 Finance Feature.
10 minutes to 2 o'clock in our finance feature for today. We are chatting about those tax traps that can catch ordinary South Africans off guard. 011-883-0702 and the WhatsApp line 072-702-1702. We're joined by Stian de Witt, Executive Head of Financial Planning at NMG Benefits. Stian, welcome to the show. Thank you so much for coming through again.
Good afternoon, Relebogile. How are you?
I am doing well, and I'm nervous for this conversation because tax traps are scary. We are afraid of two things in this life: God and SARS.
My dad always used to say, "Give unto Caesar what is due unto him, not what he asks."
I absolutely love that. So let's talk tax traps, and maybe we are not speaking about the general things that people know that they need to do with filing. Those traps that catch people off guard.
Yes. Yeah, so I think the one thing that currently is a major sore point for a lot of people, 2 years ago when the government allowed individuals to start taking money from two pots out of their pension or provident funds. What's happened, a lot of people were surprised when they received tax assessment and they didn't realize the tax weren't properly deducted, or the average tax rate was deducted, but not your marginal tax rate on your tax. So what it means is, you normally, when you pay your taxes over to SARS, you are taxed at your average tax rate. But SARS says when you take money out of your two-pot system, you are taxed at a higher rate. And that rate is anything between 10 and 18% higher. So you pay more money to SARS to get that money than what the deduction you got when you actually contributed towards your retirement. So that's the one thing, the first thing that has hit people the last 2 years with a shock.
Can you please maybe make it practical for us? So let's use a round figure. I don't know if it's 10,000 or 50,000. Make it practical that if you are taking 10,000 Rand out of your two pot, and what that means in terms of the tax implications.
Okay, so let's use a good example. You might be someone that's below the tax threshold, where you earn more 100,000 Rand, a little bit less than 100,000 Rand, and you actually don't pay money over to SARS because of you're not in that bracket where you start paying money to SARS as part of your pay as you earn. You might have a bit of UIF and SDL, but you don't really have anything else that you're paying. Now all of a sudden you take money out of the two pot, and the marginal tax rate for an individual like that is 18%, which means if you take 1,000 Rand out of your two-pot retirement fund, you will be taxed 180 Rand. So you never actually paid, you never got the tax benefit deduction when you contributed towards your retirement. And that applies to someone, let's say for instance, someone that earns a salary and they're on a 30% tax bracket average, and they would contribute, and let's say 1,000 Rand, you would get a 300 Rand deduction from that 1,000 Rand on your benefit towards your retirement. Now the day comes that you say, I want to take money to my two-pot money, and you might be on a 41% marginal tax rate. So that 11%, so you're going to be charged 410 Rand tax, but you only had the benefit of 300 Rand tax when you contributed towards the fund.
Sure. And of course, you won't know until much later.
Yeah. A lot of people, unfortunately, in a situation where they take that money and they say, I'm seeing the here and the now. They're almost like let's call it the McDonald's fast food environment that we live in. You want it here, the instant gratification. Now you get it, and then afterwards you realize it was actually a mistake.
Oh, I see what you mean. All right. So the two-pot system is the one we need to be aware of. What is another tax trap that catches us off guard?
Another one is people with a side hustle. I'm not saying you should not have a side hustle, but what happens is, remember, and so they don't do it with everyone, and you must decide if you want to take that chance. But if you do not declare money from a side hustle, then SARS might come and say, okay, we're doing a lifestyle audit on you. We see this money coming into your bank account. And here's what they then do. They say, we're taking money. We're calculating this is how much you owe us. We're calculating that. Now you need to prove me wrong.
Sure. And of course, SARS can obviously access your bank account. So they'll be able to see that side hustle one. I think many people might not have considered that. Very important one. And then is that what actually helps provisional taxpayers be in a slightly better position, because they have to, whether they're freelancers or whatever, they have to calculate everything?
Yes, that is true. But I think the one thing that's important is people that shouldn't now go and say, no, I'm not going to do it. Remember, there's a lot of expenses incurred towards that side hustle that you must actually deduct. So it's not, you're just going to go and say, it's not like your normal salary. Remember, if you have a side hustle, you might have input costs, you might have cell phone expenses, you might have products that you're buying, and those expenses need to be offset against those income. It's not like a normal income that you just take the turnover or the big amount. So that's important to keep in mind. So the Jews say it takes 1,000 days to build a business. So it can take you up to 1,000 days if you take the expenses that you incur. For instance, let's use an example, a property that you're renting out. You might fix it up a little bit, and all those expenses actually are part of the deductions that you can allow yourself or SARS to be able to earn a future bigger income.
And I think you've touched on some very, very important ones that people might not think about, but also, guys, you'll get us a bill from SARS from not filing on time. It's called penalties. We're going to have to leave it there, Stian de Witt. Thank you for your time.